Apple is now down approximately 20% year to date. So the question is now the time to purchase Apple's shares? And remember, this is a stock that's owned by Warren Buffett. That's what I'm going to cover in this video, but first, let me run the intro. What's up, guys, and let's get right into this one because I haven't covered Apple on this channel ever, and I do have a model on Apple that the Patreons do have access to. And so you can see that Apple is actually down 19% or almost 20% year to date, and it's been a bit of a choppy year for them where they declined subsequent to their March run, and then they came back up in July when the rush in the stock market happened, but of course it's coming back down now. But notice that there has been a little bit of an uptick recently. But the question is Apple cheap enough to start making a position in? Well, the worry here is that Apple actually has been the subject of a little bit of controversy right now because it looks like the demand for their newest model, or at least their phones in general, has been declining. And why is that happening? Well, it looks like demand is actually softer for their newest iPhone, because you can see here that Apple has said to suppliers to scale back efforts of increasing assembly for the iPhone 14 by as many as 6 million units in the second half of 2022. And so effectively it's going back down, or at least demand is going back down to roughly the same level as what they had in the prior year. And I wouldn't say that the news in itself is necessarily bad. I actually don't think that this is a bad news story, but what it could lead to is potentially be an indication of a further slowdown caused by a global slowdown. And what am I talking about there? Well, China, the world's largest smartphone market, is in an economic slump. And so, of course, Apple iPhone sales will decline in the country. And then notice that there's another looming overhang here, whereas that the global demand for personal electronics has also been suppressed so far in 2022 because of inflation, recessionary fears, and the disruption from the war in Ukraine. And the other thing that I would add to that is the fact that a stronger US dollar will lead to weaker translation of revenues for Apple on their financial statements this year. And what's not helping is reviews like this. So they're effectively saying here, The Verge's, that you probably shouldn't buy the iPhone 14. And the reason why they're saying this is because the iPhone 14 is a very good phone and it has a handful of useful upgrades over the 13, but those small handful of upgrades doesn't necessarily warrant that $100 more expensive price. But I would say that although this is a risk where sort of like ingenuity and innovation is sort of lacking for this company that generates more than 50% of its sales from handset sales, I would say that that pricing strategy might actually work in the favor of Apple, because if you're only going to have to pay $100 more for the newest iPhone, you probably, if having the choice, would probably pick the newest iPhone. And so I think that pricing strategy actually helps the 14, because it's not really like a technical reason why you'd want the newest iPhone. It's more of like being happy that you have the latest technology. And I think that's a lot of Apple consumers, because they like the simplicity. They like how simple Apple makes owning their electronic devices and having them pair with other devices, for example, their laptops or their speakers at home, etc. And so I could see that actually working in their favor, and I know that this is something that they've been doing historically as well. And what do the financials look like, at least historically? Well, you can see that this is a model that the Patreons have access to, and notice that the iPhone, which is that top revenue line, remains an incredibly important product for the company, and it still represents greater than 50% of their sales. Note, however, that services are growing fast. They were at 4.6% in 2014, and now they're closer to 20% in 2021. And so they've been growing at a CAGR of 35%, whereas iPhone handset sales have been growing at a CAGR of 9.5%. So I do hope that that services revenue continues to grow at its high pace, because that's more sustainable, more recurring revenues, and it'll help the company immensely going forward. And I do believe that that's largely the thesis behind a lot of people investing into Apple. And here's where I see Apple being forecasted into the future with their segments. Now, I might be the only one on YouTube who displays my segment by segment forecast, but here it is. So I'm growing their iPhone segment at around 7% for the next 5 years, and then bringing that down to around 5%. I would change that upwards if I saw some indication of, new innovations or some sort of ingenuity, but I'm just not seeing it in their handset product. I haven't seen really like trailblazing new features in many, many years. The Mac laptop, I'm growing at a very slow pace. iPad, once again, growing at a very slow pace. And then services, I'm growing at 15% a year for the next 5 years, and then bringing that down by cutting it in half to 7.5% a year thereafter. And so services is really leading the charge for their revenue growth rate. And so if you see a challenge in the services revenue growth rate, you're going to see a significant challenge in the valuation for Apple. And so you can see that overall revenue I'm expecting to grow at around 8% and then dropping that down to 5% after the 5-year mark. But like I said, I do believe that services revenue growth rate is a major thesis for a lot of investors. So if you see that slow down materially and sustainably, you're going to get a much lower share price. And so that's a big risk for Apple, especially in an environment where people are having their wallets pinched, and the easiest thing to cut are electronic services that you have subscribed to. Now, before I go into my valuation, I just want to remind you guys that approximately 80% of the watch time on this channel is from people that are not subscribed. So please, if you have the opportunity, subscribe to this channel. Now, going right into the valuation, I'm using a terminal multiple of 20 times earnings. That might be fair. It might be a little bit on the high end. It really comes down to the investor. I think it's fair for me, but you guys let me know what sort of multiple you guys are using. I'm valuing them ultimately at $130 per share. The current share price is now in the 140s, so it's probably trading at 26, 27 times earnings. So the share price as a percentage of valuation might be 110%. I would say for a company like Apple, sometimes paying a fair price for an exceptional business is reasonable, but the question is left open to you. Are you a buyer at these prices? Let me know in the comments whether you're a buyer or not in this environment. I would say that because there's a serious lack of innovation in the handset space, and the fact that you're really relying on services revenue growth to sustain the valuation for the company, I would say that I'm personally out. I would wait for this to come down significantly before I would end up buying the shares. But you guys let me know what you think. I'm very interested to know if I've sort of like made a mistake in my valuation. What are you guys thinking? Let me know in the comments below. Now, the other thing that I do want to show you is that this company is extremely shareholder focused. Notice that all of their excess capital is being paid out in the form of share buybacks and from dividends. But the other thing that I do want to point out is notice that very last line there, stock-based compensation as a percentage of revenue. Because Apple is a very senior tech company, notice that stock-based compensation as a percentage of revenue is now in the 2% range. So you are not being diluted by management compensation through shares. And so that's really good. I haven't seen a percentage that low for any other tech company that I've looked at recently. And so it really shows that Apple stands out from that perspective. And it tells you why this is very much a Berkshire Hathaway or Warren Buffett type company. But with that said, I do see risks on the horizon. Now, that model for Apple is extremely detailed, and I do want you guys to have access to that. So how do you get access to it? Well, you can get access to that model at the lower tier of the Patreon. And so if you'd like, you can join us. The Patreon link is in the description below. Now, I recently made a video on how I'm planning to triple down on Alibaba. And if you want access to that video, you can click into this link right here.